Hello again. This is Charlie Bellefontaine, and you are listening to the Homebuyers Hour, or I'm sorry, the Chicago Housing Experts. Look off and leave the country. That is a true story, but I'm sure he will come back, but we'll address that then. But right now, I'm just going to leave it as he fled the United States of America. So we did bring in another real estate agent. I want him to introduce himself. His name is Giancarlo Bargioni. Giancarlo, please give us the lowdown, who you are, what you work for, how long you've been in the business, and why you are my favorite real estate broker. I said that right in front of Steve.
Right in front of Steve.
Steve who?
Just right in the head.
Okay.
Right in the head. So, Giancarlo Bargioni, Dreamtown Realty. You can find me at Giancarlo Bargioni Group. That's my Insta. Contact info, 773-484-7744. And why am I your favorite agent? I'm just better than everyone else, Charlie. That's just it, man. Steve, I'm sorry. It's just,
okay,
it hurts. It hurts.
Okay.
It hurts.
Hurts a bit.
I'll let everybody know the secret. You know how you become my favorite agent? All you got to do is show that you really care about your clients. All right? And that's all I ask. When you put your clients ahead of yourself, then you become one of my favorites real quick. Steve, please.
True fact. Steve Davis, Real Brokerage, Kamar Group. You can find me at I'm Steve Davis on my Insta and Facebook. My number is 312-513-6314.
And Joey, I need you to tell me who you are and tell me why this economy is going to come crashing and burning and everybody's going to be dead. All right.
All right, cool. Well, I'll live in that reality. Here we go. Joey Mathews, NMLS 1330694, the VA Loan Nerd. You can find me at thevaloannerd.com across all the social medias as at the VA Loan Nerd. You can call or text me at 630-235-2405. And the economy's going to be crashing down because Trump became the president, the world's ending, and whatever else you want to throw out there. I will say this, that the ADP jobs report had a major whiff today. Did not see a huge market reaction to it. And then
what does that mean? Hold on. Back up and give me
jobs
more.
data, private payrolls. So
right.
A lack of new hires in the private side of the economy.
Okay.
Yeah, we have the oh my God, sorry. So I became the caretaker of my father-in-law 2 weeks ago. So I've been working from home and will be for the foreseeable future. So if you hear my kids in the background, it's because of my new reality.
It's all good. I love those kids.
I love it. But the non-farmers payrolls comes out on Friday, and I think we're going to see. Well, I mean, I got to see what they're expecting, but I would imagine that's going to be a big whiff with the layoffs and lack of hiring in the government and public sectors. If that does in fact happen, we will see mortgage-backed securities rise, which is a good thing. We want mortgage-backed securities to rise because as those rise, rates fall. Over the last month, actually over the last 3 months, we have seen the market dip heavily, and it bottomed out back in January 13th, and since that time we have regained our losses, so we're back to rates where they were at the middle to beginning of September, but not yet approaching where we got to in, I said December, right? I meant December, but not approaching where we were in September. So at the end of the day, yeah, man, we're waiting to see what the Trump tariffs are going to do to the economy, right?
Or if they're even going to happen. Let's be realistic, all right? We don't know.
Yeah.
Nobody knows what's going to happen. There's always been a bunch of gibbly-gock and, things that are said and things like that. But actions do speak louder than words.
Gibbly-gock.
Gibbly-gook?
Gibbly-gook, yeah.
Checking.
Yeah.
No, that's all right. It's in the Webster
Firehouse.
Dictionary.
I know how we talk.
Right. It is what it is.
Tomfoolery and ballyhoo.
Yeah, malarkey.
Yeah.
We'll get all those good words out in there. So we really don't know. And if anything has happened or proved that it's happened in the history of this great country, is that it's never a straight line where our economy goes. There's always going to be an up and a down every time that comes in there. But when you step back and you look at it over many years, it's always been on an incline. And I always go back to thinking when I got my first full-time job as a firefighter paramedic, I was making $14,500 a year. And people look at that. How do you survive on 14? Back into the early 80s when it came into that stuff. And even when I started in Northbrook, that was 25, less than 25 grand a year that I was making on that stuff. And, after 30 plus years go by, you find out that your income increased by 4 times, all right, where it comes into these things. And not only that, but I think the house prices did the same thing. I know back in the late 80s, that's when I bought my first home, or actually, I'm sorry, early 90s. It was 91. And we paid $100,000 for a Georgian in Elmhurst. I don't think you could get a condo in Elmhurst.
You can't get a studio.
You can't get anything for $100,000 anymore. But the point I'm trying to make, and that was a starter home at that time, and it was a lot of money to me. All right, at that time, and Sonny, Patrick is listening right now, so he's giving us a little bit of grief from me telling him that that he's not in the country right now. So he's texting me, as well as I deserve that. All right. But I do want to, talk about where we're going in the future. And, there's an old saying that I live by. I'm willing to predict the future as soon as it becomes the past. If I knew all that stuff, I would have bought Timex stock. I would have bought the Frisbees. I would have bought hula hoops. I would have bought a whole bunch of fad stuff if I was able to predict the future. But nobody really can. They get ideas. They take guesses. Sometimes you win. Sometimes you lose. But I think that the one thing about real estate is it's always been consistent, all right, especially here in the Chicagoland market. We don't have the big dips and the big, climbs that come into that stuff, but it has happened. Go back to 2008. We had a crash. It was legit, but we recovered with all that stuff too. And I got a feeling, because Joey mentioned if the tariffs go through, yeah, I could see how that's going to slow things down. If a lot of people end up losing jobs, when you start thinking about federal government workers, the more unemployment that we have, well, then how are they going to pay their bills? I mean, the good news is they're getting buyouts, so they're going to have income until they find something else. So that I'm kind of happy for them. But there's a whole bunch of what ifs that we just don't know about. And that brings us up to today's question was, should I rent or should I buy? And Joey, I know you shot out there right away that, you should buy. And I'm like, well, maybe now's a good time to sit back, a little bit and stay in a rental for another year and see what happens. I like to make that side of the argument, and hopefully I'm going to lose. But Giancarlo, if you don't, or you know what, Joey, because, I want to get your opinion on this stuff too. Why do you think the buying is the right move? And please don't tell me just to sell more mortgages.
No, because it is, oh my gosh, it is by far the biggest pillar, I would argue, in the your investment portfolio. Just so, I like to pull up data. So since 1963, housing values have never gone down until 2008, right?
Yeah.
And then it took 5 years to correct to get back to 2008 values.
Yeah.
And we continue to appreciate. I mean, you're looking at 60 years of data that I'm going to see if I can go even further back on this.
But that's powerful.
That's also why we always tell people that the best thing you can invest in is real estate, or one of the best.
Yeah, it's a no-brainer to me. And I personally, and Charlie, you've seen it yourself. You've lived through it.
Yeah.
Everyone on this has lived through it. I have watched clients just realize, if they bought like 10 years ago, they realized just how big of an investment it was, and they are so happy that they made that jump when they did.
Yeah.
And now people are like, oh, prices, oh, rates, oh, prices, oh, rate. I mean, you're going to get it one side or the other, no matter what. Always buy. Always buy.
Yeah,
go ahead.
I couldn't agree more, right? But I think to your point, Charlie, it all depends on your horizon and what your plans are. Okay, if you're going to be moving, let's just say in the next year or two, and obviously with all the economic volatility that's taking place and the kind of the uncertainty, it's not a very liquid asset, and we could definitely see some instability, and you may not be able to unload that for profit within 1 to 2 years when you start factoring costs or whatnot. But if your time horizon is going to be 5 years, 7 years plus, you have to remember that you're already paying a mortgage. The question is, whose? Yours or someone else's. So
Say that again. That's got to be said like 6 million times.
yeah, you know, when you're renting, you're not renting, you're paying a mortgage. But when you're renting, you're paying someone else's mortgage. When you own your home, you're paying your own mortgage. Now let's take that one step further. Now, as a homeowner, if we're really concerned about the tariffs and inflation, we know real estate is one of the few asset classes that perform and increase with inflation. We do know that if there has been or will be a recession, and there's some conversation about that right now. We know that out of the last 5 recessions, real estate has also gone up. If you're worrying about your money, well, clearly, if you have real estate, you have tax incentives. So now your tax basis could actually get reduced even further, putting more money in your pocket. And then, of course, if there's appreciation, we've got 3 levels of wealth that's being created. You've got 1 with appreciation, you got 2 with debt service buy down, and you got 3 with tax deductibility, right? So I'm always going to be an advocate to buy, but clearly you need to know what is in your best decision, right? If you're planning on moving to a different country, a different state, if you're unfamiliar with if you just moved here, maybe it does make sense to rent, right? Because it is a very, very important decision. But right now, let's just take our opinion out of it, right? Let's look at Wall Street. Let's look at big money. Let's look at institutional investors. Let's look at BlackRock. Let's look at Invitation Homes. They're buying 65% of the real estate landscape. Okay, that's millions, if not billions of dollars. We're becoming a nation of renters. So if Wall Street is actually investing in real estate, I would consider it.
Follow the money.
Follow the money.
Chime in on this, Steve.
Well, I would definitely say that as far as how the market is and what's going on, you know, with the investors, whatnot. I mean, and you mentioned, you know, when, you know, history precedes us is the fact that, you know, follow the history. It's like a bell curve where it's just gonna go up and down, up and down, up and down. Stocks up and down, up and down, down. Same thing. So therefore, I mean, one of the best assets you can, you know, purchase is real estate. You could see why the investors are buying so much and making sure that they, you know, stay liquid and they have the capital to do it. So, you know, the rent versus buy aspect, I mean, I definitely, you know, respect and understand and agree. More importantly with Giancarlo is the fact that, you know, renting, you're going to pay someone else's mortgage and you're not building equity. When you have your own home, you're building equity. You know, I bought a house in 19, I bought it for $430, and now I can sell it for $650, and I put $50 into it. So the point is like, your value will increase when it comes to real estate. As Joey said, the first time in 60 years, whatever he said, in 2008, took 5 years to regain it, you know, 2013, and now we're back into the that trajectory. So, you know, I would have to say it's smarter to buy, as long as you are, again, what Giancarlo said, as long as you're here for a realistic amount of time, you know, 4, 5, 7 years, something like that. But
it's
otherwise,
funny you bring that up because my son, he ended up buying a condo in Rogers Park. All right.
I didn't get a phone call.
This was before I met you.
All right, fair enough.
And besides that, I would have went to Giancarlo anyway because he's my favorite.
Yeah, thank you, Charlie.
I'm here for you.
He doesn't do Rogers Park.
It's all good. So, but he did buy a condo, and then a year later, he ended up taking a job in Memphis, Tennessee. So he thought it was a good idea to sell the condo. And he ended up losing, I think it was only $1,000 or $2,000. You know, there's a lot of cost.
Lucky.
There's a lot of cost into selling a home, all right?
Mm-hmm.
And you got to build that all into it. You know, I get it that when I look back at the real estate and the value of my home, we've been averaging somewhere around 8 to 10% every year, all right? And a lot of people, that's crazy. Well, I'm just telling you what the numbers are and what it's worth today.
You're in Wilmette. That blows up for sure.
It does. The nicer school districts
Absolutely.
do end up getting the property values going up quite a bit quick. But I also, you know, go back to when I lived out in the Plainfield area. You know, we bought our house there at $300,000. All right, and I took out a loan for like $290 or whatever it was. You know, we borrowed most of it. And then right around 2007, we were looking at selling our house, and I had somebody offer 410, and I turned it down. I said, no, that's insulting. And then I ended up, life got bad. We go through a divorce, and we were forced to sell, and now it's after 2008, and I ended up selling it for 260, on a short sale. Exactly. It was that rough that came in there. Now, on that same note, I was able to get into a rent with an option to buy situation because I was, held back with the short sale stuff until I could clear that one up. And I ended up buying a condo in Northbrook at a stupidly ridiculous cheap price that over that 2-year period ended up doubling. So I made a lot of money on that one, that comes in here. So you're right. The stuff goes up and down. I'm with you on that stuff. But maybe everything's a gamble. I get it. Life is a gamble. And the part I'm seeing about the buying is I honestly don't know what's going to happen, because my thought process is if they're going to add on 25% to our energy or our lumber, because a lot of that comes from Canada, or our cheap labor that comes from Mexico, if we're going to start adding a lot of that stuff on there, I see that as running the cost up. And when we run the cost up, and we're talking 25%, somebody's got to pay 25%. That's a huge amount of money. And I'm going back to what I think is the start of that 2008 collapse, and that's when the gas prices shot up from $2.50 to over $5. They doubled in the price, and people needed to drive to work. You got to make your money, so you're going to cut back on other things. And those people that relied on the other things, such as restaurant workers, travel industry, hotel workers, they all lost their jobs first, and then they couldn't pay their mortgages. Those houses go into foreclosure, and that's what actually bottomed out most of the market. Was it goes all the way back to supply and demand. I get all that stuff, and that's when I'm kind of, is this going to happen again? Well, and maybe I just got a punch in the face last time, and I'm just a little bit skittish.
What? I don't know anyone that was in real estate at that time that did not get punched in the face, okay, including myself. I would say I probably got murdered. It would probably be a better word for it. But we have to start looking at the fundamentals. And the fundamentals of the market today versus the fundamentals of 2008 were completely different. If you look at supply and demand, we were oversupplied back in 2008. If you look at the mortgage
I got to argue that one, but we weren't oversupplied in 2007.
We 100% we were.
That turned like a light switch.
No. So what happened was we had an influx of builders and anyone that there was so much money and there was so much momentum
there was a lot of building.
So much momentum in the market that we had developers building at such a rapid rate. So not only was there an influx of development happening, right? But the what was the wild card that really kind of was the domino effect was we had mortgage fundamentals were not there. To qualify for a mortgage back in 2008, all you needed was a 500 credit score and a pulse rate, and you could probably get 3 mortgages at one time. But no one's talking about that.
No, but the reason that was because the real estate was so powerful and it was going up.
Well, no, it was artificially propped. It was artificially propped. It was artificially propped. All right, 100%. It was artificially propped. So what happens is now you have all these people who weren't qualified to get a mortgage to begin with now start to default. That started the whole domino effect on top of all the existing supply that was already there. All right, so now if you actually look at the mortgage index, the mortgage availability index, you'll see that they're not giving out mortgages the way that they used to. All right. If you look at notice of defaults, they're not there, or at highs, or the level of delinquency isn't there. If you look at foreclosures, they're not there too. Right. So when you look at the fundamentals right now, what caused the collapse of 2008 was real estate. Real estate caused the recession. This recession is not being caused by real estate.
Right.
So real estate is going to continue to appreciate with inflation. So yes, is it going to be troublesome for a lot of people? Is there going to be some cutbacks that people are going to have to make? 100%. Do I see the level of appreciation increasing as rapidly as it has the last 4 or 5 years? Probably not. But do I think it's going to increase with inflation? 100%. Why? There isn't any supply right now, and the fundamentals of this market are much more. The foundation is much stronger than it was back in 2008. So, making a comparison to this market versus the market of 2008, you have to look at the fundamentals, and the fundamentals are completely different. And so, therefore, I think this time. And we know everything is cyclical. What goes up goes down. The sun rises in the east and sets in the west. All right, there's gonna be a storm. All right, and it's coming. There's no ifs, ands, or buts. It will be here. But when you're looking as an asset class that's going to actually sustain that windfall, I think real estate's in a real good position.
Joey, what do you think?
Dude, I mean, just anecdotally, over the course of the last week and a half, I've had 10 new contracts. I've had 17 people going for refis. So what we've been talking about for the last few years is, buy when you can before, people have been waiting for this rate change. And when it happens, it's great. You can refinance, right? Because values continue to go up, right? The demand does not the supply is not outpacing demand. Demand is only getting worse. I have 3 new leads just from this morning. It's not even 10 a.m. or 10:30.
Same
right?
here.
It's just.
Yeah, no, we're booked out over a week already, Joey, and I got people begging to pay double our fees to squeeze us in. I get it. I'm right there with you.
It's been like this for years. And it's getting worse because now the people that were first-time buyers in 2021, even though they have those golden handcuffs, their families are growing. They're becoming the second-time buyers. They're selling those houses to the first-time buyers. So for some people, like rates going to be the only thing they care about until they realize when they're back in the market that if they had bought, last year, the year before, this year, that even at that higher interest rate, they were still going to be insulated. There's so much insulation in the mortgage world because of how we qualify people.
I agree with that. And the thing is, though, it's not even about the rates right now. Like, I was telling a story this morning at breakfast, and I have clients that just buyer clients of mine. They have gone through this before, so they know the game. Okay, first-time home buyers, God bless them, because holy crap, this is a tough market. So last night, 14 offers. We had to go 50 grand over. They did a non-refundable earnest. They paid my buyer fee.
Did you hear Joey's sigh?
Yeah, he's like, oh my God. They did all these things, 14 offers. And they listened to me. We got it done. But how scary is that? And that it's on a $500,000 under $500,000 property. Like, it doesn't matter the number. It doesn't matter what's going on. The market itself, if you don't have a trained professional like Giancarlo and I, man, you're in trouble, because you have to be so strategic in this market, and it has nothing to do with the rates. Because as you mentioned, Joey, the rates go down, I don't know, a third, a fraction, whatever the number would be, a 0.00004, and all of a sudden you have $1 million buyers in the market. So now you have even more. And I don't care if it's a $100,000 property or a $2 million property, $2 million type of property. I did that last weekend. We saw 3 properties. One of my clients is like, all right, I'm ready to go on Monday. They're all gone with multiple offers over the weekend. All of them. Between 1 to 2 million. Like, it's an insanity market out there. So it's not about the rates anymore. It's just about the supply and demand, like we were talking about.
Joey?
Yes.
Anything else?
It is. Dude, it makes me a little bit infuriated. And I go back to, because obviously I work with a lot of firefighters, Charlie. I know you do too.
I hate firemen.
The firehouse economists, they sit at the freaking table and they talk about, oh man, it's a terrible time to buy. It's the most negative effing people in the world, dude.
I know. I was one of them.
It's a misunderstanding of market dynamics, right? And when you really understand your history and you really understand the fundamentals of a real estate market, and you know how to watch what indicators, we can't predict, but we can properly analyze. And it's just not there, right? People, still are getting married. Still, people are getting
Life goes on.
Life goes on. There's families. People are still getting relocated. Okay, those golden handcuffs are only going to be on for so long until you outgrow your home and need to be a better house. But and Joey, you'll correct me if I'm wrong on this one, but the historical average is 6.3%. Okay, for mortgage rates. So, everyone's like, I'm waiting for mortgage rates to fall back to 5. Guess what? I don't think that's going to happen. Okay, again, now, if it does, wonderful. I'll be ecstatic personally. But if you look at history, and history sometimes often repeats itself, if you're getting a rate anywhere near 6.3%, which is the historical average since data was collected on mortgage rates, that is golden right there. Now, what is reduction of 25 basis points going to do for you when real estate's just shot up 10%?
Boom, right there.
Nothing.
And this is my argument. 5 months ago, and I shouldn't say. Now I'm actually. We were talking about, things were slow. We were staying busy. We kept, doing work and stuff. Transactions were still happening, but it wasn't now. All right. And Steve, you just told me that person, if they would have bought, 5 months ago, they would have saved themselves, well, let's do 400 times 3 times 12. So roughly $75,000 is the math that I came up with based on what you just said.
On top of the $50,000 they had to pay? Sure.
No, I was adding $25,000
yeah, exactly. Now
to the
50. Then add another. Yeah, exactly. So the thing is, they would have been able to do that, but the fact is there wasn't any inventory, or they took a break or whatever. Like, these particular people took a break, and I understand why. But at the same time, by doing that, then we have a conversation. They're like, "Oh, how's the market? We're looking to buy again. They bought. I sold one of their properties. Now we're buying new property, and then they have another person that need to buy it for." And the thing is like, I had a conversation with them 3 months ago and said, "Guys, you need to get in now. If you want to wait, I respect that. I'm with you till the end, even if it takes a year." But the thing is that you're going to come across where we're going to have, again, with multiple offers. At that point, I think we barely had multiple offers, maybe like 1 or 2 on a deal.
It wasn't like it is now.
No, there were 14 on this one. There was 12 on one I did the other day, and I did not win because my client couldn't play the game as much as these clients could. And the thing is like, not everyone is the same. Not everyone is going to be equal. So when it comes to this, it is crucial to understand. That's why Joey says jump in now. That's why Giancarlo says jump in now. That's why I say jump in now.
Charlie says rent.
Charlie, go home.
Charlie's sitting pretty on that.
Charlie's an old man. He's an old man.
Exactly.
Charlie means rent from him.
Yeah.
Charlie's going to go buy investment properties.
I'll give you a negative to renting. All right, here. Well, a lot of these. Like to start and end somewhere around May, June, July. Is that a true statement?
Yeah, it's prime rental.
It's prime rental time. All right.
Between April to August. And people say differently. I did rentals for 6 years. I guarantee you that's what it is.
I agree with Steve.
And okay, so the point I'm trying to make is that, and we know that it's cyclical, by year. We know that when we start around Christmas time to the Super Bowl, that's actually the slowest real estate time. I know we were all busy. Give me a little time. But those seem to be like the area where the buyers have more leverage. I saw a scale one time. It was a pendulum swing. Is the leverage going to the sellers or is the leverage going to the buyers? And man, if I can get that every month, I would love to get hold of that data just so I could figure that out. I think that's powerful. But I really think that right now, man, this is a very seller's market.
No, it's not even a question.
Yeah,
it is.
And I mean, it's almost pinned seller's market.
If sellers, I mean, seriously, sell your property, have a lease back situation, rent back or post-possession close for 60 days. Close in 60 days, have 60 days, you have 4 months to find a property. That's the best call.
Or just don't pay the rent. How long is it going to take them to kick you out of there now? So that's like a whole year, right? So you got a year or 2 months to find a place.
No.
Doesn't work that way? All right, that was the comedian portion of the show here, so please forgive me.
Joey, why don't you go into this? The mortgage aspect is you can do a post-possession close for 60 days, correct?
Yeah, if you're going to do longer, I don't want to see that on paper.
Meaning
Let's
that
be
is
real.
illegal, folks.
Yeah, yeah. Don't do that.
Right.
No, it's because after 60 days, it's considered an investment property. So all the terms that you signed as a primary residence are no longer valid. Anything over 60 days, unless it's a VA loan, we got some ways around that. You got generally up to a year where you could do post-possession close. But don't go buy an investment property on accident.
Now, is there a lot of people in the Veterans Administration? Are there a lot of employees that are also being let go during all this transition?
I honestly am not even watching.
No?
Yeah, just very bluntly. I am solely focused on the things that I can control, and once I see the data track over to my side, then I worry about it.
Yeah. No, I got you. One of my inspectors, his wife works for the VA, and she's being heavily pressured to resign. And I think it's an important job what she does. She works with suicide prevention for veterans, and that's her major deal.
That's a
It's
really important
It's
job.
a big thing that veterans go through and stuff like that. And suicide is real, and I think that's a real big thing. But she's being pressured real hard to, take
Send a
the
weekly
buyout.
email update.
Yeah.
Oh, I gotcha.
Well, it's more than that.
That's terrible.
And stuff like that. And that's why I'm curious on, I honestly am way ignorant on what is being cut and who is being let go and what the reasonings are. I don't think anybody really knows the truth when it comes to a lot of that stuff. But I don't know. I'm digressing.
So you were saying something. I'm sorry. You started saying something.
Well, no, I think where we kind of went off on a tangent there, but we were talking more about whether you should rent and you should buy, and I think the consensus is there, right? Clearly we know that there's a storm coming. We know that real estate is an asset class that continues to rise with inflation. We know out of the last 5 recessions that we've had, 3 times real estate has gone up. One time it went down, that was 2008, and then one time it only dropped about 2%. So it's a great hedge against inflation. We know Wall Street is dumping money into real estate, so that's always a positive indicator. We know that with all of these tariffs, it's safe to assume that things are probably going to get more expensive. It's also safe to assume that with inflation, people are going to kind of run out of the stocks and start running towards the bonds. And Joey, we do know that's not necessarily good for interest rates. We could actually see interest rates potentially rise, but we do know because of supply and demand, just to take basic economics, real estate is probably going to continue to increase, and we're starting to see that on the front lines. You got to look at your soldiers. You got to look at the front lines. Forget about high-level 30,000-mile point of view, right? If you talk to Steve and I, who are literally on the front lines daily, dealing with buyers, dealing with sellers, me working with sellers, I am shocked that I've been able to sell things posting on my social media. People are calling me up, lining up the door. I put a property on the market at 5 o'clock, that's definitely not what you're supposed to do, okay? But I did, okay? By 8 o'clock at night, we've got 14 showings on a property, okay?
Oh my God.
That's just ridiculous. 5 o'clock, by 9 p.m., I'm getting blown up.
Yeah.
I'm with my kids, and I'm getting blown up. I got to get into this property tonight, tomorrow morning at 6 a.m., 7 a.m., before the rest of the market does, right? So the indicators are extremely strong. Now notice the defaults. Look at foreclosures. It is non-existent. People aren't defaulting.
That's big.
Foreclosures are just not there. They're at the lowest levels we've seen in a very, very long time. And then guess who's cherry picking the best foreclosures? Wall Street, baby. Investors.
Oh yeah,
All right.
BlackRock.
Exactly. So the reality is that we know right now is you need to get in. You need to get in, and I think that it's really important just to kind of understand that I don't think there's going to be any softening in prices anytime soon. And when there is a recession, now look, let's just kind of unpack this a little bit further. Let's look at the history of real estate for the last 100 years, from boom to bust. Every 18 years has been a real estate correction. Okay, but what no one's talking about, and this is the John Carlo theory, guys, you're not going to see this in the books, but I will take credit for it if it becomes true. Okay, 2020, we probably would have seen a correction had that not happened, but because that kind of reset the market, in my opinion, where rates dropped down to 2%, 3%, okay, which is wild, that just gave the market a tailwind. All right. And here we are now. So I think the correction already happened, and it was so mild, people missed it. And so now it's all resetting, at least with real estate. So everyone's like, oh, another crash, another crash. We are scarred from that. We all know. But it's just not coming. All right?
It's funny that you say that with the scarring from that, because I said it too. I was scarred. I got punched in the face with it. But then if you really start thinking about what really happened to me, I made out like a bandit. You know, yeah, my house was not worth what it was worth before the 2008 crash. I got that. But then I bought another property that wasn't worth what that was worth either before the 2008 crash. And when everything recovered, I was in a nicer school district at that point in time, and I actually recovered better than I would have recovered on the house.
Yeah, and now,
That's
I'm sorry,
huge.
Steve, go ahead.
No, I was just going to say, you said every 18 years. I thought it was every 10 years.
I think it's on the eights, too. I'm going every 10 years.
Yeah, I thought it was every 10. And the thing is, I'm not disagreeing or agreeing. I'm just saying, in general, like, it made sense on the 10 aspect, and 2020 would make sense, but I thought we were way overdue anyway. So
we had a
Nothing's making sense.
we had a
we had a recovery.
2012. It's been a bull run.
18.
Yeah.
Since 2012.
Yeah.
Joey said it.
Yeah.
2012, the market re-corrected in 2012,
Yeah.
and it's been on the rise since.
Yeah.
So if you look at, if you say 10, the data that I'm reading, which could be inaccurate, is around 18, right? So I was always telling everyone, that 2024, right? That's probably when we were going to see this. 2022 is probably when we were going to see this correction. I thought there was going to be some fractures in the market. The fundamentals just weren't there. That never came. And then 2020 came, the pandemic, rates just dropped, prices inflated, they'd shot up, and here we are now, right? So
and there's no inventory.
And there's nothing.
The rates are higher.
There's no indicator.
Are higher.
There's not an indicator out there that would suggest real estate's on the decline.
So do we think we're going to be shooting fish in a barrel type, so to speak, in the next year or two?
What do you mean by that?
So what I mean by that is you were able, like, everyone was able to find a property. Everyone was able to buy. Everyone was coming out there to look. Everyone was selling, so on. So shooting fish to barrel meant just basically like it was such an easier market because there was a ton of inventory. It was such an easier market because the negotiation.
We're talking about buyers,
right? Buyers
okay.
and sellers.
Right.
I mean, so yeah. I mean, it's more buyers, obviously, but like, yeah. Do we see that in the next couple of years?
I don't think it'll get to that much.
I don't think we're going to see inventory come back to the same levels that they were during that time. I mean, I remember back in 2012, you could go out and show a buyer 13 properties and then maybe even get in a second time. I didn't like any of the 13 properties that I saw today. Let's look at 13 more. And there were 13 more to go see. God. You could show someone 30 properties in a week. And it was there. Like, it was just that much inventory. Now you're lucky to see 8, and if you even see 8, you are consider yourself privileged. Good luck, and good luck that 4 out of the 8 are going to still be on the market if it was actually a pretty attractive property. So, no, I don't think it's going to get any easier anytime soon. I think what in my opinion, now with all this, with the administration, their current policies, love them, hate them. Let's just talk about how it impacts real estate, right? Now, clearly, I work with a lot of builders. We know that, right? And we know that 14% of laborers are undocumented workers. They're not showing up to work right now.
14%.
14%. So now you're already taking a fractured industry where labor is scarce, right? Quality labor. Reduce that number by 14%. Guess what these laborers are going to start doing? They're going to be in high demand. Prices are going to go up. Mm-hmm. Okay? So now the cost of production is going to increase. The cost of production is going to increase. These developers, they're not in this for free. They got mouths to feed too. They've got payroll, right? They're going to pass that cost on to the consumer. Now, the wild card I do see, and I'm starting to kind of see it a little bit, is we know that appraisals are as a lagging indicator of value, right? And so as these new costs arise, because the developers can base a cost on their past project, but they can't predict what labor costs are going to be. They can't predict the 25% tariff on imported goods. We don't know what that cost is going to be. So clearly, it's safe to assume that the cost to build is going to increase. They're going to attempt to pass that cost on to the consumer. The market may be willing to pay for the premium, but if they're going to leverage a mortgage, the value on paper from a comparable perspective may not necessarily be there. So I think the threshold, right, or I would say maybe the kind of like the anchor a little bit to kind of cool this market off would be that the banks are going to be extremely conservative, and they're going to, if the market just doesn't support the data based on comparables and conforming approaches to values, we may see prices not increasing at a rate that they probably should or could because of that. So I think if anything, that's probably what's going to kind of cool this market off, is that it's not going to get too hot because these banks aren't going to make the same mistakes they did again. They're not going to give.
Oh, they didn't make mistakes. They
made mistakes.
They did not. They followed the government rules.
When? In 2008?
Joey, do those rules change often?
Well, lending rules, absolutely. Yeah, we get new updates from Fannie Mae, Freddie Mac, the VA, FHA.
So those
every couple months.
Those are the entities that make the decisions about what you can loan out, right? The banks don't make those decisions.
Well, no, some banks do, right? It depends on if you're working with portfolio programs or if you're working with GSE programs. GSE programs are the government service entities that get sold off to the government. So Fannie Mae, Freddie Mac, Ginnie Mae, they securitize all the loans, right? So if you're going to be selling those to the GSEs, they have to fit into the box that the GSEs create. If it's something outside of the box, and actually this is where the mortgage world is going to be big this year, is the non-QM space, so the things that won't be sold to Fannie, Freddie, Ginnie. Seeing a lot of DSCR loans. I have 4 DSCR loans I'm working on today.
These guys are all nodding their heads yes with DSCR. I have no idea what that
is. I think our listeners need to know what that is.
For sure. So it's a debt service cover ratio. Long story short is it's an asset and credit-based loan, right? So we're not actually looking at income docs. The appraisal is what's going to tell us how much the home is valued at and how much the rents are going to bring in every month. They're going to have the rent rolls on there. So we're going to see if your mortgage payment is $1,000, right? Easy math. They're going to get the best debt service cover ratio rate terms at a rental income of $1,250. It's a 1.25% ratio, right? Or 125% ratio. I'm sorry. So and this takes for self-employed people that write off a lot of things that are looking to get into investments. I don't need your tax returns anymore. The only thing I need is assets. Make sure your credit's pretty decent, right? So anything over 660. Actually, I think I have investors that'll go down to 640, but again, it's purely based off of what your mortgage payment, your total PITI, principal, interest, taxes, insurance, and association dues, versus what your rent is, your area rents are going to be for that property, right? Very popular right now. Very, very popular. And most investors are going that route rather than providing the tax returns, providing W-2, providing all the documents, because it's an easy loan to do. But it's not a GSE loan. It goes to non-QM investors, who are places that have funds that create their own rules to support these. And I love it.
I'm sorry that I was arguing with you a little bit.
No, please. It's good. This is important.
I always feel that it's, our federal government is basically what sets all the laws and the rules that the banks follow by. And when we make it lean or easier to get the mortgages, then, they're going to qualify as many people as they can.
Let's look at now. So now the regulations are and lending standards are far more strict. And Joey can correct me if I'm wrong, because and this is not my expertise, right? But prior to 2008, there wasn't Dodd-Frank. Okay, it was the wild west. All right, banks weren't talking to each other. There weren't databases. There were mortgage originators, not Joey, but there were mortgage originators that were wild, that they were going in and they were lending multiple mortgages on one person, submitting the loan application to 3 or 4 different banks. You had one buyer qualifying for $400,000 properties, and the banks didn't know about it. So you had a lot of that loosey-goosey, wild stuff propping the market. You had ghost mortgages. You had bad appraisers.
What's a ghost mortgage?
Ghost mortgage was the people would put silent second mortgages, right? On properties, and then pay an appraiser XYZ to inflate the value.
There was an episode on Sopranos. No, it was.
Well, I actually lived through it. It wasn't a movie script, Charlie. But the truth of the matter is that you can't.
Sopranos was real too. Don't even try and argue that.
Oh, 100% it was.
Thank you.
The best show, one of the best series still to this day ahead of its time. So I will not argue about Sopranos. Matter of fact, I watched it the other day. But when we talk about real estate back in 2008, it's just not. It was completely different back then. It's not the same what it was today. So the real estate collapse was what caused the recession of 2008. The lack of fundamentals, the lack of standards of 2008 is what caused this whole crisis. Today, those standards are in place. This market is a lot stronger than it was. Okay, now.
But those regulations can change, and I guess that's where I was going with all this stuff.
No,
and that's why I asked Joey, how often do they change?
Well, Joey, you could even say now, look at what happened in Surfside.
Yeah.
The collapse.
Surfside.
Now, if you got a condo development, and in the meeting minutes they have anything related to any type of structural integrity, soundness, garage repairs, facade restoration,
balconies,
Fannie Mae may say that's ineligible.
Yeah.
And now you can't lend on that property. So now, if anything, standards are getting stricter. They're not getting looser.
Okay, I'm good with that. That does not upset me.
Yeah, and that's actually really good, because at least you know that there's standards and regulations in place so that we don't actually see the same thing that we saw. Now, but again, let's just take the lending out of it, right? If you look at the supply, you look at the delinquencies, you look at the notice of defaults, all right? You look at, the mortgage credit availability index. They're not lending money out like they used to, and the probability of delinquency is just not there, right? I think the wild card right now is inflation, these tariffs, right? And then the cost of production. So builders are not going to be able to build because acquisition is going to be too highly cost. So now, if anything, that's going to put further constraints on the market. And it's going to put further constraints on the inventory. Now what's going to happen? That's going to definitely put upward pressures on prices. So the reality is, at least right now in the short term, I don't see real estate softening anytime soon. In fact, I see it rising tremendously, and the only thing that's going to cool this off is the values, because of how conforming approaches to appraisals take place, where you need 3 comps and whatnot to actually justify the value. Unless there's proper adjustments and you've got somewhat of a liberal appraiser, you're not, the value may not necessarily catch up with the demand.
Well, it's interesting you bring up the appraiser aspect too, because I remember that there was times when we had issues with appraisals itself and so on. I probably have 2 out of this, like last year, not any this year, knock on wood. The thing is, though, is that with all these the multiple offer situations and so on, we're going to run into a lot of appraisal issues, in my opinion, and that's why it's so important that you obviously know how to play the game, advise the client the right way, gap appraisal waivers, so on, that kind of thing. And the thing that I believe, just like you had mentioned, with the real estate going up, you mentioned the storm is coming, and the question is that it's not a storm due to real estate, right?
It's an economic storm.
So it's economic storm. Why don't you elaborate real quick on that? I'm curious to hear more about what you think.
The economic storm is, all right, we've got an administration that's doing something different, okay? Which, whether you like it or don't like it, it's here to stay, and he's doing it, okay? So what do 25% tariffs mean, to the market? Well, we're already starting to see the stock market, being a little bit volatile. It was a major dip, yesterday. I haven't looked at it today, but as of yesterday, the market dipped. Okay,
but that's another thing that consistently goes up.
Sure, fine. I mean, listen, we all know stock market over time, 8% annual rate return, follow the S&P. Wonderful. We're not going to disagree on that, right? But I do think that, okay, if there's 25% tariffs, we've got Doge coming in and and laying off a lot of people, and if wherever there's a large federal presence, okay, we're going to start seeing people. But here's the difference, Charlie, and this is one thing I wanted to kind of talk to you about is, okay, if people are losing their jobs, let's just say because of layoffs or whatnot, okay, let's just say people can't afford the same standard of living because of inflation and whatnot. The difference today is that their houses aren't underwater. If you actually look at the amount of equity that people have in their homes, right, it is substantial. And I think there was a data point, and don't quote me on this, but I think the median equity that people had in their house was a couple $100,000. Okay, so people can tap into that, or they can actually sell that asset. Here was another interesting statistic that, let's just say, all the foreclosures that are currently happening right now, which banks are working with buyers, there are programs to keep you in place. But let's just say all the foreclosures that are active right now came on the market at one time. Let's just say hypothetically, okay, we had all the workers, they all wanted to sell their houses in one time. If you look at the market within a market, which is like Chicago, we got neighborhoods within neighborhoods. We got Forest Glen has 5 different neighborhoods. We've got boundary lines and so forth. We would only have a balanced market. In some markets, there's less than a 1 month supply. Mm-hmm. You know what that means? In 1 month, there will be no more homes to buy or sell. So if we get an influx of 5 months of inventory, that'd actually be healthy for the market. It would slow appreciation. It would actually help affordability, okay? But the truth of the matter is it cannot happen. It would not happen. That would not happen. That type of scenario just doesn't exist.
Mm-hmm. But a lot of that comes into with the builders as well, especially when we get out to the more the outskirts, when you get the Pulte's and the Ryans and the William Ryan. When you get all the bigger builders building all the housing, they're adding a lot of inventory, to our system, and that helps bring those prices down as well. We just don't. Now we're going to have those tariffs coming in there, the wood, appliances, everything else. Those prices are going to go up too. And that's going to, if they can't make money, they're not going to be building homes. They're not in business to lose money. They're in business to make money.
So now we got supply and demand because people are still getting married. People are still getting divorced.
They're still making babies.
People are still making babies, right? People still need to relocate. And the sad thing is, people are still in debt. Mm-hmm. All right. So when you look at the 5 Ds of real estate, that's life.
That's
okay.
Life.
So the natural cycle of inventory will start to come back on, but the tenureship where it was 5 to 7. It's probably now 7 to 10 years where people are staying in their homes a little bit longer. Why? Because they all know I'm not going to get a 3% mortgage. My next mortgage payment will double. Right. And sadly, people don't live within their means.
No, I'm with you there. And we only have 1 minute left, and I want to get our contact information out there again. Just one final note, though. Building wealth, real estate, investments, and savings. And those are the 3 main pillars to go ahead and build wealth. And I think that's what we're trying to focus on here. Giancarlo, please give us your contact information again.
All right. So Giancarlo, Dreamtown Realty, Instagram, Giancarlo Bargioni Group, 773-484-7744.
Steve Davis, Real Brokerage. You can find me on Instagram. I'm Steve Davis, as well as Facebook. And my number is 312-513-6314.
And my favorite mortgage broker?
Joey Mathews, VA Loan Nerd. VA Loan Nerd on all the social medias. You can call or text me at 630-235-2405.
And you still do have the most romantic voice out of all of us here, no matter what happens.
Got a good voice, Joey. Yes, you do.
My name is Charlie Bellefontaine. I own Chicagoland Home Inspectors. Our phone number is 312-544-9180. Again, I'd like to special thank you to Henry, for taking good care of us today. And Devin, we miss you. And Patrick,